Hello guys, welcome back. If you're returning, welcome back, and if you're new, welcome. So this is me, and as promised, I said I'll be dropping videos summarizing ICT mentorship. So this is for episode 1 and 2, and I'll be dropping the keynotes, things I observed that are important for you to know without you are going through the entire episodes over and over again. So this is going to help not just you, it's going to help me also in my journey as an ICT mentee. And obviously the end goal is to become funded, obviously, which I would apply for my funded account with this mentorship strategy. So yeah, having said that, let's just go and make this quick and simple. So yeah, this strategy is meant for which market? Normally, ICT himself, he said he's going to focus on the NASDAQ and S&P, then the Dow. See, these are the markets he will focus on in this mentorship. But this strategy can be used on Forex and other markets. It's the same algorithm that delivers the price. But my own personal point of view, I believe from the charts, this strategy happens a lot. Like its setup happens a lot on the S&P and the NASDAQ futures. It happens a lot there, but on the Forex, it's just you need to be really attentive for you to see the moves, and it doesn't happen every day. So yeah, that's that. Now, what to expect from this mentorship? In this mentorship, you are going to learn a skill set that will change your life, and which I believe is true, because having this skill set is something you're going to have for your life, and there's no retirement. It's just like an ATM machine. You just go into the market, you take whatever is yours for the day or for the week, move on when you know what you're doing. So have that in mind. So what to look out for in the market? So I'll be listing out things to look out for in the market. These are the key points I got from the video. I summarized them, into the daily, the weekly, the hourly, the minutes time frames. So these are the things you're meant to look out for. We have weekly time frame. So on the weekly time frame, you have to have your weekly bias. That's where is market most likely to draw to. So ICT himself, what it does, it uses seasonal tendency and the Fed rise in interest rates in earning seasons. So it uses, like, the second one actually has to do with news. So it uses news and the seasonal tendency. Like most times the market tends to do one particular thing in a season, like in a period. Maybe during this ember period, the market might choose to go down, and if you check over history, you see that the market normally falls during this period. So based on seasonal tendency, and you see that the interest rate is low, which can make market fall. So combine them and you have your weekly bias according to this episode 1 and 2. I know going forward, like, there are other things we're going to add, to determine our bias. So going to daily, once you've gotten that, you go to the daily. So on daily, what I'm looking out for is the fair value gaps, the draw on liquidity, either to the high or the low. Yeah, they're looking for swing highs and low. So above swing highs, they are buy stops, and below swing lows, they are sell stops. Sell stops can be limit order, can be stop loss. These are liquidity. So the algorithm is trying to engineer liquidity. So you are just trying to anticipate the move of the algorithm. So equal highs and equal lows. These are things we need to look out for on the hourly chart. Okay, so now you've successfully gotten your markups. You marked up the highs, the lows, the equal highs, the fair value gaps, the FVG, and you've determined your weekly bias, where is market most likely to draw to for the week. Now, where is price coming from and where is it likely to draw to on the daily time frame? That's what you're going to look out for. Like, okay, what did he react to? He reacted to something, right? And he's moving away from what he reacted to. So where is he likely to get another reaction? That's the key note. Where is it most likely to get another reaction? So that's where your mind should be at. So on the hourly time frame, what you're expecting market to do. So this is a sell scenario. And I have to specify it to a sell scenario. When you want to see a buy scenario, just do the reverse. So we are expecting price to first take out the sell side liquidity first before taking out the short term high. Then price can deliver lower. So we know that market wants to go low. So in order for the algorithm to induce buyers or induce people to grab liquidity from, it will four of us sell, take out a low. Now, taking out a low, more sellers might have put their stop loss there. It would have taken them out. Now, it will go and take out the high, because people saying that, okay, this is a low, and they bought lower, their stops are below the entry normally, and more people come in at the top once price breaks the highs. So there are buys and limit orders there. So the markets will go and take out the highs, the short-term highs, before reversing impulsively lower. And doing that, okay, it's going to deliver lower. So what I have to look out for is first market taking out the lows, taking out the highs, then we can expect it to go lower to react off the next zone. 15 minutes time frame, what are we looking out for? Yeah, this is like the entry time frame. Is at this point we start looking out for imbalances. That's the FG, fair value gaps, FVG. So after a significant move occurs, when a short-term high has been taken out, we look out for sell setups and we can take it. This is for a sell scenario. So the reverse is the case for a buy scenario. So once the market trades above a short-term high, after grabbing sell side liquidity, we go to the lower time frame, the 5, the 3, the 2, the 1, and 4 included, 4 minutes time frame. There we look out for significant displacement lower to take out the short-term lows. Now, once these short-term lows have been taken out, you will expect price to come back to a zone where it moves rapidly away, which is the displacement, which would leave an imbalance, the fair value gaps. That's where you're going to place your order, your sell order, and you're going to ride it to the next low or area of markets where markets would engineer liquidity. So he gave us an assignment. So we have to determine where an opposite high or low reside. Then log and backtrace the number of handles you see in hindsight. So basically what we're trying to do is determine how much move that we get from seeing this in hindsight. Okay, we saw the setup happen here, it happened there. So how many move in handles? You call it handles, that's what they measure the futures with, but normally in first we measure it with pips. So we can say, okay, how many pips did they move away from this setup? So that's the assignment. I'll be doing mine, and hopefully before my next video, which I'll be uploading soon, you should have done yours so you can compare. So I'll be doing mine on, I saw that in BTC it's actually working perfectly, so I'll drop a setup on BTC and and the futures also. So it's nice that you're still here watching this video, and I'm grateful that you're supporting this channel. Hopefully I'll be able to do more of this, so do like and subscribe, leave a comment. I'll respond to every comment. Let's see if this channel can grow, and also let's see if I can get this done. I'm profitable with ICT mentorship and giving you guys quality summaries. Alright, thank you for watching. See you guys soon.